Nissan Joseph joining us, CEO of Metro Brands. Always great to talk to you, Mr. Joseph. Tamanna here, and I hope you're having a good morning. All right, let's go through your numbers. Margins have improved. Now, just explain to us that this tax expense versus tax credit, is this a one-time thing, or are we expecting to see this on your balance sheet going forward as well?
No, Good morning, Taman, and thanks for having me. It is a one-time thing. So last year, with the demerger of Fila, we were able to get some relief on the tax side of it. And on this year, we had an expense on it. But it's a one-time thing. Both of them are one-offs for the quarters. We don't anticipate seeing anything else come up. But what's important really is if you look at our EBITDA growth for the quarter, it far outpaced our sales growth, continuing to show that there are lots of economies of scale and lots of cost controls and leveraging that happens as we grow our business.
Okay, so just coming to that EBITDA growth that you're obviously rightly pleased with, revenues as well. Is this getting pushed by better demand coming in, better footfalls at stores, e-commerce? Where is that boost coming from?
The short answer is yes, but the longer answer is, it's coming from a few places. One of them is, better margins that come from better margin controls and less discounting that happens. As you know, last quarter is the clearance quarter that we have typically in the Indian retail cycle. We have two of those. And Q4 is when we used to liquidate a lot of end of season sale goods. So that despite that, we were able to control our margins, which is a reflection that we didn't have as much go on sale. That's one. There's a lot of cost controls that we put in place on our expenses that also plays a factor. We also have finally got through the Fila cleanups that was dampening our EBITDA. And that's great news that we're now got done with the liquidation of Fila old product. Now we start to focus on the repositioning of the brand in our stores and in the country. So that's the other factor that's helping us too. So, and overall, when you have revenue growth of almost 10%, that definitely flows through to the bottom line.
Mr. Joseph, good morning, Neeraj here. So I presume you've also aligned the royalty expenses for Fila with the expected revenue growth for the next 2-3 years. So suffice to say that will not be a bugbear on the operational metrics for at least the next 3 years.
Correct. No, and I think we just wanted to restructure it because the liquidation took a little bit longer. But now that we're past that liquidation, we should be right back on track.
Now, a lot of talk around the consumer and the economy itself, and divergent views there. I would love to know how you think about it, and therefore, what would it do to store additions and same-store sales growth? Because I see that you added about 18 stores, you closed about 5 during Q4. How do you think about this piece?
Yeah, so there's a number of moving parts to that question, right? So first and foremost, let's just talk about the consumer. There's a lot of lumpiness in when you go against last year's sales, right? Because last year you may have wedding dates, you may have had heat waves, you may have had elections. You have those kind of lumpiness that come in through. Not to talk about the fact that in last quarter, we also had a leap year day last year that we didn't have this year, right? So there's always those kind of fluctuations that happen. What's important for us to see is that all our banners are starting to see growth, which means that consumer at the premium level is coming back on a more regular basis. We've always talked about the turbulence post-COVID, right? The up and down, the lumpiness that comes with it. Now we're starting to see it get on a more stable business pattern. So, that's one part of it. The other part of it is through the last couple of years, retail rents have been rising significantly because a lot of people have decided to open a lot of stores from the euphoria of COVID, post-COVID sales. We're starting to see that slow down a little bit too. So we should see our new store expansion get back on track. The bottom line is, Neeraj, we're not trying to hit a number when it comes to store openings. What we're really trying to do is open profitable stores. And, as you know, we have substantial capital that we can deploy to opening stores. So it's just a matter of finding the right locations at the right prices, because these are 9-year leases, right? So we're not going to be short-sighted about those things.
Mr. Joseph, your e-commerce sales are up 45% as well year on year. And just taking on from what you just said, is the focus going to be more on brick and mortar retail, or are you doubling down on e-commerce?
Yeah. So e-commerce is one of those businesses that you can drive, but unfortunately, you drive it through discounting. What we are starting to see is that our investments into the omni-channel structure that we have in place, the infrastructure that we have to support an omni-channel business, which is full price, the investments we're making into our .com sites that are owned and operated by us are starting to pay off. So it is not a question of walking away from our brick and mortar stores. Fortunately, we've seen the consumer likes to shop in our stores and has continued to. We always thought that post-COVID that we would see it flip the other way, and the e-commerce would fall off and brick and mortar would rise. Good news is both happened. So which means that there's a rising demand among the consumers in India.
What is the revenue split right now for offline and online, or e-commerce and brick and mortar?
Total digital commerce sales is a little north of 10%.
Are you seeing that growing? But you're saying that's discounted, so you wouldn't want to push it that way.
Well, a part of it is, Taman. Not all of it is. The part that's not, we would like to double down on. The part that is, we want to control it, because don't forget, e-commerce does give you eyeballs across the country, across PIN codes that you don't have stores in. So it's important to have the presence on e-commerce. It's not something you can walk away from. And more importantly, most of our customers also are digitally savvy and start their journey on the digital space first. So you have to be present, you have to be active, you have to be leading that space with content and whatever it takes to be a standout in it.
Mr. Joseph, just as we wrap up very quickly, the guidance for FY26, is this for, are you giving I know you don't give necessarily a formal guidance, but some color there, and could it be present continuous in that it might well continue into FY27 as well?
Yeah, so you've seen us have 2 quarters worth of double-digit growth, right? And what we've guided to at a long-term basis is somewhere between a 12 and 15% CAGR, right? And we're not going to jump right back up to that overnight, but I think the indications are that we are headed that way. So that's a positive for us, that we should be getting back on that track. Overall, we feel good about the consumer sentiment that we're seeing out there, the way they've taken to some of our new ranges, our new collections. Overall, it's been an upbeat experience.
Okay, Mr. Joseph, all the best for the quarters ahead. The stock is bumping up as the management is speaking to us, by the way, so keep that in mind. But thanks, Mr. Joseph, for joining in and giving us your thoughts.